Does ESG investing lead to higher returns? What does an ESG rating actually tell you? And how should an investor integrate ESG? I'm Ari Polychronopoulos, head of ESG at Research Affiliates. With the rise in popularity in ESG investing have come many competing claims and investor confusion. We'll sort through these questions and discuss our research on ESG investing today. The question I'm most often asked regarding ESG investing is whether or not ESG is a factor. A factor is a stock characteristic associated with a long-term risk-adjusted return premium. Examples of popular factors are value, low volatility, and momentum. All three factors are grounded in academic literature and have been vetted over decades. In addition, these factors have been shown to work across varying definitions and geographies. For example, the value factor, which was originally documented in 1977, has been shown to work whether you define low price stocks using a variety of fundamental metrics like book to price, dividends to price, or sales to price. When evaluating whether or not ESG can be considered a factor, the first criteria to consider is that there is no academic consensus around ESG providing a long-term return premium. In Is ESG a Factor?, my co-author and I tested various ESG metrics by creating long-short portfolios sorted by a company's overall ESG score and also looking at individual environmental, social, and governance metrics. Here we show the results of our test within the United States. While 3 of the 4 metrics exhibited a positive alpha, none of the metrics we tested had a statistically significant t-value. We also tested these metrics in Europe and got similar results. As a result, one should not expect ESG scores to lead to long-term positive risk-adjusted returns. Examining what an ESG rating actually is provides some insights into these results. An ESG rating is a representation of hundreds of different metrics, both material and immaterial, that aggregate up to an overall ESG score. An ESG score and individual environmental, social, and governance scores are rather noisy signals. Determining whether this metric can reliably be considered a return driver is made even more difficult by the fact that long-term data for ESG scores, like 50 or more years for many of the other factors, simply doesn't exist. In addition, ESG scores are determined by various ESG ratings firms, all with different methodologies and criteria for determining a company rating. The correlations of ratings from these various ESG data providers is often low. Here, we look at results in the United States and in Europe for individual environmental, social, and governance ratings for 2 different data providers. The pairwise correlation of these ratings range from about 0.4 on the low end to about 0.7 on the high end. So, as an ESG investor, how should one proceed? While we don't think ESG is a factor, we think it is a powerful theme that will continue to grow in coming years as investors continue to value the importance of sustainability. In ESG as a preference, not a strategy, we recommend that investors rely on already established factors as the return drivers in their portfolio construction approach, and use ESG as an overlay to achieve their social objectives. An investor using a cap-weighted index strategy that tilts towards companies with high ESG scores should expect a return similar to that of the overall market, which isn't a bad thing if you're looking for broad market exposure while satisfying your ESG objectives. Our RAFI ESG index series relies on the fundamental index approach, a contrarian rebalancing strategy that weights companies by fundamental measures of company size rather than market capitalization. The index starts with a company's fundamental weight and tilts towards companies with high overall ESG scores. By doing so, it maintains characteristics similar to the underlying index strategy. Looking at the RAFI ESG Developed Index compared to its non-ESG counterpart, the RAFI Fundamental Developed Index, you'll see that both strategies have similar price to earnings, price to book, price to sales ratios, and similar dividend yields. Given these similar characteristics, investors should expect similar return over time, mainly 1 to 2% outperformance driven by the contrarian rebalancing strategy of fundamentally weighting each index holding. If you would like to learn more about our ESG research and insights, please visit researchaffiliates.com/insights/ESG. You can also follow us on Twitter at RA_insights or on LinkedIn at Research Affiliates. Thank you.